what we're seeing today, the talk of the soft landing, is particularly reminiscent of 2007. In particular, again, back in 2000 and 2007, central bankers with their models that see the economy and the financial system, insofar as they think of the financial system at all, as being in equilibrium, they don't really worry about financial upsets. And, back before the last two busts, they were primarily concerned with inflation, just as they are today.
Welcome back to Breakout from Breaking Views, sponsored by PGIM. I'm Peter Thal Larsen, the global editor of Breaking Views, and I'm joined once again by Eddie Chancellor. Eddie, good to have you back.
Nice to see you again, Peter.
So this week we are talking about soft landings, really. I mean, it seems like we're in a situation at the moment where the financial markets are still just about sort of expecting a soft landing in the economy, even as interest rates have gone up and hopefully inflation comes down. But you've been sort of exploring an idea that says actually that may not be right at all. So tell us a bit about what's wrong about those assumptions.
Well, okay. So the first thing to point out, and people forget this, is that when we get to the end of every speculative credit cycle, the market, at least in the last two cycles, in 2000 and then 2007, the markets were expecting a soft landing. Now, after the global financial crisis, any mention of soft landing was quickly forgotten, but that's how things were. And so what we're seeing today, the talk of the soft landing, is particularly reminiscent of 2007. In particular, again, back in 2000 and 2007, central bankers with their models that see the economy and the financial system, insofar as they think of the financial system at all, as being in equilibrium, they don't really worry about financial upsets. And before the last two busts, they were primarily concerned with inflation, just as they are today. And the question is, after 2000, in 2000, and again 2007-8, Fed funds rate, the US central bank's policy rate, had climbed up to a sort of cyclical high, and then the expectations of soft landing were quickly followed by, first of all, an enormous stock market crash in 2000 for the next 2 or 3 years, and then the financial crisis, the global financial crisis of 2008. So the question is, with the Fed funds rate back at the same level, peak level it reached in 2007, are we at the same moment of vulnerability, and is the soft landing a piece of wishful thinking?
Yeah, I see. So the question really is sort of, can the financial system, after this very long period of very low interest rates, zero interest rates, can it cope with higher interest rates, or will there be a sort of a crack and then we then have to go back to lowering interest rates again?
So I cite work by a maverick British economist called Bernard Connolly, who's got a new book out on central banks and their impact on the financial system in recent years. And
it's about central banks. It's called "You Only Hurt the Ones You Love: Central Banks and the Murder of Capitalism." Just to give you a gist of what it's about.
Bernard is not a man known for understatement. Anyhow, so Connolly tells an interesting story. He argues that 25 years ago, or more than 25 years ago, the Federal Reserve under Alan Greenspan made an error by keeping interest rates too low when the productivity was growing strongly in the mid-1990s. And that helped fuel the stock market bubble. And then we had the bust. And then, if you remember, interest rates were taken down to 1%, and then we had the housing bubble, and then we had the bust, and interest rates taken down to 0. We had lashings of QE and so forth. And of course, in Connolly's analysis, you've got more and more wealth, virtual or bubble wealth building up in the system. And you can, I think we probably talked about it before, the US household net worth is roughly at 6 times GDP, and rough, sort of more than twice the level it has averaged in the post-war period. And that wealth is really being kept up by this very low discount rate, the very low interest rates. And then we've got masses of debt. There's not so much household debt as there was before 2007, but the aggregate amount of debt is still very high. At the moment, this year, the US government is running a big fiscal deficit, as you know, and that sort of seems to be keeping the show on the road. But as Connolly says, and I had an interview with him earlier this week, he says this is unsustainable. You could only sustain it with very negative interest rates in the long run, because you've got, otherwise the debt would carry on growing higher. So I'm just saying that Connolly, who actually has, at least is on record for having been one of the economists who predicted the financial crisis, and he also, to his credit, predicted the Europe sovereign debt crisis that emerged a couple of years later. He is nailing his colours to the mast and saying no soft landing this time.
Yeah.
We are still in this cycle of boom bust, except each bust is bigger than the bust that precedes it.
Yeah. So what we've seen for a while, the fact that we had this sort of, people look at the bond markets and we had this inverted yield curve where the short-term rates were going up, but the long-term rates were quite low. And then in the last few weeks, basically the long-term rates have been picking up. And you think that's a potentially dangerous moment?
Yes, and this is something actually I hadn't really thought of personally before. Is everyone talks about the inversion of the yield curve being a sort of indicator of recessions or market busts. But Connolly says it's not the inversion of the yield curve, the fact that long-dated yields are below short-dated yields. It's when the long-dated yields start rising when short-term rates are already quite high. And that long-dated yield is, or bond price, is really the yield that the stock market, for instance, is valued off, and the US stock market, on long-dated valuation measures is pretty high today, and also the rate at which corporations borrow. So, and in the United States, if not in Britain, it's the rate at which households' mortgages are. I read recently that the US 30-year borrowing mortgage rate is over 7% at the moment, which is pretty hefty.
I see. So that sort of then begins to feed through into the economy. So very quickly, just to sum up then, you're an investor sort of observing all of this and worrying about the sort of the cracking of the next bubble, as you say. What is there anywhere for people to hide?
Well, I think so. The long dated bonds, you can take inflation risk out of them in the United States by buying inflation protected securities or tips. And now the 30-year bond is trading in the range of yielding around 2.5%, around that rate. Came in a bit lower at the beginning of the week. Now 2.5% yield is roughly in line with with the long-term expected growth rate of the economy. So I think that's probably a fair yield under normal circumstances for an inflation-protected bond out at long duration. Now, if Connolly is right that a hard landing is around the corner, and when the hard landing comes, the central banks will have no choice but to go back to lowering interest rates, that long-dated yield, that long-dated bond is going to produce very high returns. Now, think of it, in the UK, where those 50-year linkers, index-linked bonds fell by 80%. Well, if Connolly is right, they actually might be in a position to regain most, if not all, of their losses. So we will see in the next 12 months whether that pays off.
Eddie, fascinating as always. Thank you very much for your time, and talk to you again very soon.